Okay, this article is just a little bit on the long side, but it's a really good article, and I think it's very important. Uh, the article is titled "An Unstable European Banking Union Has Been Created," and it's Jean Dermain. He's a professor of banking and finance, and here's what he has to say. There, in my opinion, is an urgent need to address the shortcomings of an unstable European banking union, writes Dean Dermain, professor of banking and finance. Uh, the euro banking market met recently two episodes of great instability. In September 2016, Deutsche Bank was threatened by the U.S. Department of Justice with a $14 billion penalty. Financial markets had a brutal reaction, with several hedge funds reducing their counterparty limits with Deutsche Bank. In December 2016, instability rose in Italy when the authorities had to deal with their third largest bank, Monte dei Paschi. There is something unique in the Eurozone that is causing instability? Question mark. He's asking that question. Yes, he says, a new single resolution mechanism, which in our opinion should be revised urgently. Since 1st of January 2016, the European Union has set up for the 19 members of the Eurozone a banking union and a single resolution mechanism. It's called an SRM. A single resolution board has the right to intervene early to impose losses on shareholders, bank holders, and depositors. Objectives in handling a failed bank. The single resolution mechanism works as follows. Once a bank has been identified by the European Central Bank, the supervisory authority is failing or likely to fail. A single resolution board decides whether private solution is possible or if a resolution in the public interest. Three main objectives in handling a bank failure are swiftness of decisions to minimize the impact on the economy, privatization of losses to stop the linkage between public bailouts and public budget deficits and sovereign risk, elimination of moral hazard with the bail-in debt held by private creditors who bear losses. The Bank Recovery and Resolution Directive, BRRD, defines the scope of the bail-in tools which may be applied to all liabilities of an institution that are not excluded. The resolution authorities shall not exercise a write-down or conversion power to the following liabilities. So what they're talking about here is that they're not going to exercise a write-down if there's the following liabilities, and they list them here. Deposit covered by deposit insurance, secured liabilities including covered bonds, liabilities with remaining maturity of less than 7 days. So they're not going to cover if they have deposit insurance. So they have to do a bail-in. It says they define the scope of the bail-in tools, which may be applied to all liabilities of an institution that are not excluded. Okay, avoid widespread contagion. So they want to avoid widespread contagion. In exceptional circumstances, such as trying to avoid widespread contagion, the resolution authorities may exclude or partially exclude certain liabilities from the application of the write-down or conversion powers. A privately funded single resolution fund may make a contribution to cover the losses, but only after a minimum contribution of 8% of total liabilities, including own funds, has been made by shareholders and other liabilities. There can be no doubt that the creation of a single resolution mechanism is a fundamental change in the way banking markets function. The authorities have finally succeeded in privatizing risk and losses. Economic welfare would be ensured, with all costs and risks being priced by the market, avoiding an unjustified public subsidy for bailing out banks. In addition, the link between bank losses, state aid, budget deficits, and sovereign risk would be severed. Run on fragile banks. However, the current single resolution mechanism is a potential contributor to a future panic and disruption of the banking system for two reasons. These concern the ability of the private market to bear losses and a much increased likelihood of a run on fragile banks. If creditors who bear losses happen to be retail investors, pension funds, or insurance companies, one can imagine the political uproar that would arise. A recent example occurred in Italy in November of 2015. Preempting the bail-in rules of the Bank of Italy imposed losses on a bondholder on 4 small local banks, losing all life savings. A customer of Banca Intesa committed suicide after losing his life savings. He had invested all of his wealth in bonds, a safe investment distributed by his bank. It would seem imperative to know who are the investors, individuals or institutions, holding bail-in securities to ensure that they can bear the losses. Second, the fact that unsecured depositors with more than 7 days maturity are potentially exposed creates the risk of a bank run. Any treasurer with the slightest fear of a resolution will not renew deposits, and banks will face major increase in liquidity risk and probability of a bank run. So it's saying here that unsecured depositors with more than 7 days maturity, in other words, if you've had your money in the bank for more than 7 days, you're considered an unsecured depositor. And it says they are potentially exposed to the banking problems. In other words, you're going to lose your money. That's what they're saying here. And that's going to cause a risk of a bank run. It says urgent needed. Note that the directive states explicitly that the special circumstances some deposits might be excluded, but given the ambiguity, any prudent treasurer will run to withdraw deposits. In such cases, the European Central Bank could act as a lender of last resort to solvent banks, but again, the presence of ambiguity, there is significant increase in the likelihood of a run by short-term depositors. An unstable European banking union has been created. There is, in my opinion, an urgent need to address its shortcomings. So there's the article. Basically, what the guy's saying is, well, I'll sum it up. He's saying that the European banking system is unstable. Instability. That's the key word here. Thank you for listening. Like and subscribe, and bye-bye for now.